5 o'clock in London, it's midday in New York, midnight in Hong Kong, 2 a.m. in Sydney, 9 a.m. in San Francisco, and 9:30 at night in Mumbai. Greetings, good morning, good afternoon, good evening, depending on where you are in the world today. My name is Patrick L. Young. The IPO-VID Livestream, Series 30, episode number 1. That is in the aggregate, episode number 175 starts here. First of all, let me say I must apologize. I am currently at this juncture in midair. Not that you can tell from where I am at the moment, because, of course, we're recording this show. We're on a mega trip to Asia right now, so you'll hear some interesting Asian recollections once we get back. But we got a couple of recorded shows to get through over the course of the next few weeks. Thank you for joining us, ladies and gentlemen. We're thinking about Southeast Asia, actually. While some may say Chinese worker productivity is not fabulous, the reality is China is the world's only manufacturing superpower. It has 31.2% of global output. That was in 2022. America trails at 16.3% in second place, and the rest of the world are also RANs. Japan, 5.3%, Germany, 4.6%, India and South Korea, 2.9% and 2.6% respectively. Nobody else in the world is more than 2%. So in other words, nobody's managing to get more than about 6 or 7% of the total of that 31.2% of China. And surprisingly, Mexico has 1.9% ahead of Russia. There you go, comrades. Obviously, post-communism, it's all collapsed and gone very, very pear-shaped. Actually, Mexico's really just a big production area for the United States of America, isn't it? Anyway, ladies and gentlemen, on those interesting thoughts, I would like to welcome our guest today, Dominik Roesch. Our topic, How Floors Help Markets. A recent academic paper by Dominik discussed the benefits of floor traders. So here we are. Let's meet one of the authors. Dominik Roesch is an associate professor in finance at the University of Buffalo. His research focuses on market quality, in particular investigating the joint dynamics of arbitrage, liquidity, and efficiency. He's been part of an NSF infrastructure grant, which allowed him to build up a framework based on OneTick software to efficiently analyze market financial data. Dominik, greetings. Welcome to IPO-VID. Where in the world are you today?
Hi, Patrick. It's great to be here. I'm in Buffalo, which is like Western New York, close to Niagara Falls.
Excellent. So you're not quite halfway to Toronto, but you're coming reasonably close to the Canadian border, where obviously there's been lots of excitement going on for the course of the last number of weeks with their election showdown, etc. How did you manage to get, first of all, from where were you born? Germany? All the way to the US?
Yeah, I was born in Germany, close to Bonn. I studied math first and then worked in the industry for a couple of years, actually as a quantitative analyst in Malta and in Malaysia, but decided to change my career. So I started a PhD in Rotterdam, Erasmus University, and there I started a framework to analyze like high frequency data. My advisor, Matthijs van Dijk, he bought like international tick-by-tick data. And as you can imagine, it's huge. I think it was in total like a petabyte. And my job was to analyze this kind of data. So luckily I came across OneTick, as you already mentioned, great software to help you both store as well as analyze these vast amounts of data. And after I finished my PhD, I got a job offer in Buffalo. And that's how I ended up here.
Okay, fascinating. So, I mean, quite the story altogether. As a matter of interest, did I hear it correctly, you were working originally in Malta, amongst other places?
Yes, I was working there. While I was studying math, I wanted to see the real world. So I did an internship for half a year, but they kept me there for another half a year and then asked me to help build up an office in Malaysia. And so that's how I ended up in Malta as well as in Malaysia for a couple of years.
Wow, that's quite incredible. And how did you find it? So you were in Kuala Lumpur?
In Malaysia, yeah. It's actually called Cyberjaya. I don't know if you heard about it. It's like this new kind of Silicon Valley in Malaysia. I started there, I think it was 2004 or so, and there was pretty much nothing. So regularly I go back and it's just amazing how it changed. When I started there, there was one small supermarket and no taxi went there. So it was quite isolated. But now I think it's a proper town, a proper city by now.
And actually, do tell me, because I'm not sure, because I've not been to KL for years. How far is that actually from downtown Kuala Lumpur itself?
It's quite close. So they have this rapid train. I think it takes like 20 minutes.
Okay.
It's probably halfway KL to the airport.
Oh, okay. That gives me a very good idea altogether. Yes, I remember that airport well. I remember flying into it when it had just been finished, actually. Quite incredible altogether. It's amazing how Malaysia has built those sorts of issues, because I remember going to various of their offshore islands at different times, and indeed they built a fantastic offshore island just opposite, or at least not an offshore island, but an offshore financial center just opposite Brunei a number of years ago, which was quite fascinating in Labuan. I remember being there shortly after it had opened, and it was essentially a port, a building site, and 3 skyscrapers. It was quite amazing.
Never been there. I did love the islands.
The islands are fantastic, quite incredible altogether, and obviously quite interesting to visit after you've had the experience of living in Malta, which must have been very, very good fun, I'm sure.
Yeah, I lived in Slima, which is close to Valletta. It was quite nice. It's quite a small island, so I enjoyed. I stayed, I think, 1.5 years or so. I enjoyed my time there, but it's quite small. So after a while, it's nice to see a bigger country.
It's nice to have a large, sprawling area around you, and you certainly get that when you're in Buffalo, because you've got a huge amount of area. Good grief, you've got lakes that are nearly the size of bits of the Mediterranean around Malta at that stage. So you made this great leap forward. You arrive in the USA. What is it like? I mean, coming from the European academia into US academia.
So the academia is quite similar. I think by now it's still quite US centered, actually, at least in finance.
But I mean, it's only fair, isn't it? I mean, given the fact that they're 60% of the world's stock market capitalization, I think the USA is allowed to be pretty US centric when it comes to finance, right?
Well, I mean, if you look at the market cap by itself, that's true. But I mean, the number of stocks actually seems to be declining, at least publicly listed. So it's pretty much dominated by a few very huge stocks like Amazon and the other stocks with $1 trillion.
Yes, good point. Yes, I mean, the concentration is absolutely incredible amongst those series of 6 or 7 trillion, multi-trillion-dollar stocks, of which you've got the largest ones like Nvidia and so on are all hitting around about the same market cap as Paris' stock exchange, which is quite sensational. So tell us then, I mean, a little bit about your research. I mean, we're going to get to this paper in a minute, talking about the floors and so on. You're working your way through all of this tick data. Isn't it an amazing world? I mean, I can remember when we originally had floors, you wouldn't have had anything like this richness of data as you go along. What are the kind of issues you come to in terms of the data integrity to start with for your research?
So the data by itself is just huge, so it's difficult to work with it. I remember, even when I started, in 2000 or so, a year's data is much less than it's now. So now it takes around half a terabyte for a year, and even more. I mean, depending on what kind of data you look at. And especially a lot of the data you often drop anyway. So you often might be interested in minute returns. So a lot of the data you will kind of have to drop. It depends on what issues you're looking at. But often the biggest challenge is actually aggregating the data to something that you will then use to analyze further.
So that becomes very, very interesting, because obviously then you're analyzing what stock data that is an aggregation of NMS, or how do you work?
So the main data source is TAC, so trade in quotes. So it contains the best bid and ask across all different trading venues, and so prices, sizes, and trades as well. The main bulk of the data are the quotes, so the best bid and ask. And so I mainly look at, as you said at the beginning, whether markets are efficient, what makes them efficient, how arbitrage affects market efficiency, these kind of areas.
So interesting. I mean, therefore, you've obviously had the advantage. I mean, you're now in the US academic system. You did your PhD in Europe. Do you see a lot of differences between the data and the way that it's formulated, or the way you can work with it, between Europe and the US?
So I think a lot of the academic research is dominated using US data just because of its availability. So the TAC database, a lot of universities subscribe to it and use it. European data or worldwide data is a bit more difficult to get to. So I mentioned at the beginning what was called Thomson Reuters tick history. Mm-hmm. It was actually distributed by Circa in Australia, and they had kind of a mission to help academics, and therefore the price was reasonable. But now it's managed by, I think it's still managed by Thomson Reuters, but it's extremely expensive and it's difficult to get hands on. I mean, unless of course you pay for it. European data is getting more available, but it's still not as popular and not as easy to
Interesting, very interesting. So therefore, despite the fact that we've had all of this great aggregation of markets, MiFID II and MiFID I and so on, we've still got a problem. Do you think that that's something that Europe can solve with this ongoing project to create a consolidated tape?
I think, yes, consolidated tip should be an easy way to also distribute it to academics. I mean, it's a lot of the pricing as well. So academics normally can't and don't want to pay like the same fee as in the industry. On the other side, academics often don't need real-time data, so similar as what works with stock, so that you can get maybe delayed data for a discounted price or even historical data. I mean, that would be great. I mean, a consolidated tape, I think that's probably the main advantage in the US for academics, that you have like this one source to get all the different exchanges.
Yeah, obviously consolidated tape, something that has been great, although the politics of the SIP and so on remain with us at the moment. And yeah, the difficulty, as we can see, with trying to extend that into 24-hour markets and so on becomes quite incredible. Now, tell us then, I mean, your research over the years, you've been developing different areas of research. Talk to us a little bit about your process, as it were. I mean, Victor Niederhofer wrote that great book, The Education of a Speculator. What's been the education of Dominik Roesch, a financial academic?
So it probably started when I was like a quantitative analyst. So we were pricing derivatives contracts, exotic derivatives. You can call it a bet, so binary options. And we noticed, so one day we saw like a spike in volume in one exotic contract. It's called a range bet. So that pays off when the underlying doesn't move out of a specific range. And we noticed a big jump in volume on this specific contract. And when we explored further, we realized that there was a competitor that provided exactly the same contract, but at different prices. And the prices were such that it allowed an arbitrage. So it was quite interesting for me because the client didn't face any risk. So he just bought, he or she bought on our side and sold on the other side. No risk for the client, but we obviously had a lot of risk. So what we did is we just increased the bid and ask spread. So if you think about an arbitrage, you have like in each side, you have like a price at which you can buy, which is the ask, the higher one, price at which you can sell, the lower one. And then you have another market, similar bid and ask spread. And if the spreads don't overlap, well, then you have an arbitrage, because then you can buy the lower one and sell the higher one. And the gap between both is your immediate profits. So what we did to prevent that kind of arbitrage is we just increased the spread till the arbitrage disappeared. So that means in our case, the arbitrageur actually harmed market liquidity. So liquidity as the difference between the bid and ask price, the ease of trading. But then when I started in academia, I read more and more papers that said that arbitrageurs are actually contribute to market liquidity as well. So I was curious how the different ideas of the role of the arbitrageur actually came in place and how it works if I analyze it in more details. So that became my solo authored so-called job market paper titled The Impact of Arbitrage on Market Liquidity, where I then investigated in specifics the ADR market. So you have like Vodafone trading in London, but also trading at the NYSE. So you have, again, these two different markets where the same stock is trading, and you have an arbitrage when the gap don't overlap. And then I investigated how the arbitrageur that trades against these price deviations actually affects liquidity. So first come that it depends on why there is a price gap in the first place. So in our case, when I was thinking about my work experience, what the arbitrageur, so why there was an arbitrage, is that it was probably information-based. So we were not completely certain of how to price it. So in our case, the arbitrageur actually created adverse selection risk, which decreases liquidity, so you increase the spread. But it could also be that the price deviation actually represents price pressure. So it could be that there's a big order on one side of the market that pushes down the price. So the market, the liquidity providers on this market, they decrease the price to attract orders of the opposite side. In this case, the arbitrageur actually helps them because he moves some of the order imbalance from one market to the other market. And in this case, the spread would go back up and the arbitrageur would improve liquidity. So I first distinguished these two different cases of why arbitrage arises. And in the ADR market, I found that it's pretty much always price pressure. And then consistent with that, using statistical techniques later on, I investigated the impact of their trading on the liquidity. And I did find that when arbitrageurs are active, liquidity improves in the future.
Fascinating. Really, really interesting altogether. And quite intriguing, as you say, over the issue of things like range bets and other very sophisticated derivatives, because for the arbitrageur, of course, it was sublimely simple to manage to arbitrage the positions. But for you and indeed the other party who was creating the sophisticated derivative, good grief, what a lot of effort you had to put into creating the derivative in the first place for this guy to literally just take a couple of ticks of free profit out of you. A huge amount of effort, which ultimately rewarded him for very little effort or no risk whatsoever, essentially. Well, some counterparty risk. That's fascinating. So as you developed along this way with arbitrage, how did that bring you towards looking at the concept of what remains of floor trade?
Well, so the main question is about market efficiency. And there are other areas, tick sizes and also dynamics of market efficiency. But floor trading is also one aspect of it because it also relates back to my work experience. So when I was in Germany, I remember, I worked at the Eurex, the option exchange, Deutsche Börse. And I remember I toured the offices and there was an opening of the market. So the market's always opened manually. And apparently there was an order that seemed wrong. And the person that was supposed to open the market manually called the provider of the order, which was a big investment bank, and said that maybe there's something wrong. Do you want to check it? But they didn't. So then he was still concerned about the order. So he called again. And then it turned out that there was some kind of mistake. And so the counterparty, the investment bank removed the order and then the market opened. So that kind of intrigued me about the importance of humans' interactions. Because nowadays it seems like a lot of areas are taken over by like machines, and the role of the human trader seemed to diminish. If you think about the US equity market, the only one that actually still has the floor is the NYSE. All other ones have only limit orders. I'm not sure in Europe, I think there's no floor at all, right? And they probably
there are any equity floors left. No.
And they already moved way earlier than the US to electronic trading. So the human trading seemed to get less and less important. But at the same time, it's really difficult to estimate the impact of human trading because clearly, if you contact a human trader, such as a floor broker, you would only do that with very specific orders. So just looking at the market quality, so execution quality of trades executed by floor brokers versus limit order book wouldn't really give you any indication because it's endogenous. So it's similar to if you would look at the life expectancy of people that go to the hospital. It's only specific people that go to the hospital in the first place. Therefore, you would need to compare the life expectancy of people that are sick. So, and the sick ones that go to the hospital and the sick ones that don't go to the hospital. Similar, we would need to compare the execution quality of complicated orders that go to the floor traders and complicated orders that go to the limit order book. And that's clearly difficult. But then COVID closed down the floor trading mechanism. All the traders were still continuing, but they traded only on the limit order book. So it's not that there was a shock to the liquidity provision, it's just the way the liquidity provision worked. So everything that happened on the floor happened now on the limit order book. And that gave us an opening to study how the human traders actually affect execution quality, market quality.
Fascinating. So just walk us through this. I mean, we don't need to know exactly your secret sauce recipe, but you broke down what was the order flow that was absolutely purely electronic with the order flow that was going via the floor of the NYSE, and then compared that to the rest of NMS. First question on top of that I'd have to ask is, how much actual data is going to the floor of NYSE? Because, I mean, it's a relatively small amount of trades and transactions compared to the overall national market system, right?
So, I mean, we don't really know how much goes to the floor. There are some proxies that you can use. So, for example, the NYSE allows like so-called parity trading, and that is more extensive when the floor is open, because these ones are often used by floor brokers. Similar D orders, so D orders can only be used by floor brokers. So these things we can identify. But in general, whether a trade went through the floor or through the limit order book, it's more difficult. So that's why we aggregated data. So we aggregated data of execution quality. So, for example, effective spreads within the day. And then we compared, which is called the diff and diff setup. So we compared the execution quality of NYSE trades before the closure and after the closure to a control group. So we matched like NYSE stocks to Nasdaq stocks. That would be the control group, one control group. And the other control group is where we matched NYSE stocks that traded on the NYSE to the same stock that traded on other exchanges. So then the other exchanges would be the control group. So the diff and diff is always that you compare changes around the event and also compared to the changes for a control group. This control group is always the tricky part because ideally, as I mentioned before, you would want it to be exactly the same. But clearly, you cannot observe a trade twice. It either decides to be executed on the floor or on the limit order book. But because of this exogenous shock, where the floor closed, we knew that there would be nothing on the floor. So that allowed us to use this diff and diff to estimate the impact of the floor.
Interesting, very interesting. Now, actually, I think for the benefit of those of our viewers who actually are people who work at places like Eurex and other places, just run through very quickly for me, please, D orders on NYSE and parity orders, because I know they are unique to the NYSE, but it's just useful to have a good definition of those, please.
So the parity is an interesting concept. The idea is that orders don't just execute by price time priority, but that even orders that are submitted a bit later are still part of the execution. So normally you have, let's say, an order comes in and sets the best ask price. And now there will be an order that can execute it against that. So it will be executed in total against this, because that has highest price time priority. But with parity trades, you have that, okay, so the order comes in and sets the best ask, but then there's another order coming in with the same price, but just a bit later, and another, and so on. And when now an order comes to execute against this best price, the later ones also get a share of the volume. So I think I forgot the details, but the first order that sets the best price, I guess, gets like 40% of the volume. but the rest of the orders also get a percentage of the volume to be executed.
Interesting. So it's very much like the old-fashioned floor traders' practice of actually proportionately allocating across all the people who were on the bid at a particular moment when you had an order, except in this case it allows for a momentary delay because it's electronic and therefore fractions of a second are involved.
Yep, exactly. I mean, I didn't know about the way how it works with the floor traders in the past, but yeah, it sounds exactly the same.
So in a floor, it's very interesting actually, because depending on what floor you were on and how fast the market was moving would be how you would do it. But generally speaking, if the market wasn't insanely fast, you would offer your share of your order proportionately actually amongst all the people who are actually trading. Although you could get into fraught situations. For example, someone had a very, very large order they were trying to execute, and they might actually not want to take 1 or 2 or 5 lots at a time. They might actually really only want to execute simply because writing tickets became a pain in the backside. Now, strictly speaking, they should have taken the order, but in sort of the working practice of floors, you could quite often see that happening. So I mean, that's essentially what we're talking about. Something similar with parity, and it's obviously good for the person bringing the other order in because they should be getting a better price as they go along, which is good. And so that's cool. What about D orders then? Sorry, what are those?
So D orders, they are called discretionary orders, and they are mainly or only relevant for the auction. So the idea is that the auction, I think at the NYSE, you can submit orders to be executed at the auction up to 10 minutes before the auction happens. So up to 10 minutes before 4 o'clock.
Right.
Unless you submit an order that goes against the imbalance. D orders, on the other side, they can be submitted, I think, up to 10 seconds before 4 o'clock.
Okay.
And they can also be cancelled, but they are only available to floor brokers.
Okay. So there's a clear proportionality. Cool. So that gives us a great idea and understanding of what goes on, because I think one of the difficulties that people have nowadays with the NYSE floor, and actually having been there myself last July the 5 most recently, it's a little bit difficult to discern what's really going on from the floor of the NYSE because it doesn't have the open old-fashioned pits of the futures trades like Chicago or wherever, nor does it have the same allocation of specialists standing around as was the golden age of the NYSE floor previously. So tell us, I mean, what does the floor do then, and how does it help the market overall?
Well, I mean, so when the floor closed, there are 2 things that happened. First is clearly all the participants of the floor, like DMMs and floor brokers, they left. But with it, they also lost access to specific orders, such as the D orders. So just to be able to distinguish which of these effects, so whether it's like the human interaction between DMMs and floor brokers, or the access to privileged orders affected our results, we can use the reopening of the floor. So the nice thing is the way of how the floor reopened was that it happened in stages. And the first stage was when all the floor brokers came back, and with it the access to privileged orders such as D orders. And only in the second stage we saw that DMMs and floor brokers came back together. So that allowed their interaction again. So we didn't find any result, at least, I mean, we did find some results in the auctions when the D orders came back, but not during the continuous trading session. The main effect came back when both DMMs and floor brokers were back. And we interpreted it as that it allowed them to talk to each other again and therefore handle more complex situations. So if you recall my example about the way the market opened in Germany while I was there at the Eurex, where the person called the counterparty and really wanted to confirm whether it's a correct order or not. I mean, algorithms will have difficulties to simulate that, right? So for algorithms, it's difficult to deal with complex situations while they are excelling in routine situations. So that's also what we found. Like during the day, when liquidity provision is more routine, when trading is more routine, there's not much effect, but not much effects of the floor closing. But when when the market is in turmoil, I mean, when there's a lot of information impounding into the price, such as during opening sessions, we see the biggest effect of the floor closing.
Fascinating. We're going to come back to this in just a moment. We're going to give you a moment to have a glass of water and refresh yourself for the second half of the show, Dominik. We're here with Dominik Roesch. We are enjoying discussing how floors help markets. Unfortunately, ladies and gentlemen, well, fortunately for me, because I should be in the lap of luxury, I'm somewhere halfway between Europe and Asia as I speak right now. Well, not as I speak right now, because we're recording this, of course, but we are at the moment recording this show. We're discussing how floors help markets with academic from Buffalo in the USA, Dominik Roesch, originally from Germany. Interesting conversation altogether. However, there is one thing happening to the north of Buffalo, which is arguably even more exciting than the politics of the USA, at least for the course of the next fortnight. Going to be the debates over the course of actually this week, as you're watching this show, for the Canadian general election. It's the Canadian election showdown. Mark Carney versus Pierre Poilievre. Canada's future is on the line, as we know. We've seen the resignation of Premier Trudeau. He's been replaced by Mark Carney, former boss of the Bank of Canada, boss of the Bank of England, a complete neophyte. He's been on the stump now for several weeks. This week is going to be the crucial moment for him in the election campaign as he heads towards those all-important debates. One coming up, I don't believe it's tomorrow, is going to be in English and the day after is in French, but I may have got those mixed up. However, let's watch a quick short video on the Canadian election.
Meanwhile, big world. It's general election time in Canada, coming slightly early. Mark Carney, political neophyte, former governor of the Bank of Canada, governor of the Bank of England as well. One of those terms was successful, one of them wasn't. He's now the leader of the Liberal Party. He's taking over the Trudeau mantle, trying to run somewhere from the centre of Canadian politics and hoping to defeat Pierre Poilievre as the next incoming Prime Minister of Canada. What's going to be happening? Tariffs. That's going to be a huge topic. Mark Carney's trying to get all Canadians to rally round his flag and manage to re-elect him. Will the gamble work? It's going to be very interesting to see. He's still in the honeymoon period. For more in Big World, like or follow.
And there we go. We're going to have the Anglophone Mark Carney against a polyglot Mr. Poilievre, not quite Poilievre, which it sounded like on that video. My apologies to all of our Francophone viewers. Also time, ladies and gentlemen, to consider a couple of our books of the week. We didn't actually mention our book of the week last week. It was The Fabulous in Defense of Global Capitalism, which was written by the magnificent Johan Norberg. Check out his IPO vid from the canon of IPO vids, wherever you're watching this show. A really, really interesting discussion. Now, we're back discussing how floors help markets, piece of fascinating in academic research that came out recently. Joining us for that is Dominik Roesch. Dominik, I'm very interested. You've hit upon a couple of things we've been talking about here in relation to human interaction in markets. And actually, I mean, you make some very good points. One of the most interesting issues that I was involved in, I think, over many years was when the floors closed, how the rules of the exchange needed to be changed. Because in the old days, when you had an error on the floor, it was actually relatively easy. You had 1,000 people all standing around the edge of the floor on telephones, and they could all go, oh, it was that, whoever, insert someone at random, Patrick Young, who made the error. That's what's gone wrong. Whereas, of course, when you get errors in electronic markets, everybody suddenly goes, it's a conspiracy, and they bring out their best JFK theories, and 64,000 pages of documents have to be released, and nobody actually knows anything more than they did before. So it's quite fascinating that, and it's very interesting you hitting on the idea of the proactive intervention from, for example, that lady or gentleman at Eurex who was trying to create an orderly market and make sure that the options market didn't go mad. Also, the great example of the euro yen in 1980, I'm going to say 1989, I think it might have been 1988, when they launched that on the Tokyo International Financial Futures Exchange. Someone put in an order that was completely wrong in one of the back months, and they executed 100 basis points away from where they should have done on what was essentially a flat yield curve. And strangely enough, the floor traders all over the world all thought that should have been immediately cancelled, but the trade wasn't cancelled. And strangely enough, never another problem of its ilk in Japan. Interesting how these things interact and go forward. So you did this research. So what do you discern? What are the advantages that a floor is bringing to the mix And indeed, possible spoiler alert, I presume what you're going to say is that the best example for the world is a hybrid rather than simply having a floor or a purely electronic market.
Exactly. So, I mean, there's several papers lately that document the advantage of the combination. I think it's always important to see these as tools, and they don't replace. They are great to be used as a combination. So I think like AI, machine learning, they're great tools where the market is similar as it was before. So that's partly how they are learning. I mean, they are investigating, they are learning from the past and extrapolate it to the future. And that works well when the market is calm, when the market is stable. But it doesn't work well when the market is complex, when the market is in turmoil. And that's exactly when the human interaction can add value.
Yes, and of course, I mean, that was always the fascinating thing that, I don't know, empowered, I think, a zillion documentaries about the stock market crashes the world over throughout the course of, I'm sure you can remember them, I can remember them from my childhood, of the old-fashioned specialists, because the specialists just had to take things, and essentially the uptick downtick rule worked very much to their disadvantage because they had to essentially accept orders. So you think that the addition of having some floor trading basically builds a degree of backbone into the market when we've got very, very unruly trading?
Yeah, exactly. So, I mean, the specialist is now replaced by the DMM, but I think the roles are quite similar, maybe slightly less privileges than before. But they are still hired by the exchange to create an orderly market, and they discuss and talk to floor brokers on the floor. And I think this human interaction can help to handle especially markets where a lot of information comes into play, where, I mean, unpredictable things happen all the time, and humans are just much better to deal with these than algorithms.
Yes, it becomes quite fascinating how human interaction can manage to thread order out of chaos, perhaps with a degree of fuzzy logic, but nonetheless, we somehow or other manage to make it really work. So, I mean, did you come up with a prognosis of how the overall market system could be improved, or if there's anything that may make the marketplace even better on a hybrid basis?
I think, I mean, in general, there are probably a couple of regulations that could make the market better. Some of that might be even removing some regulations. So, for example, whether tick sizes really need to be regulated or not, maybe that's a question that should be revisited. But at the same time, you have a lot of frictions and a lot of hurdles to bring prices back to fundamentals. So I'm just thinking about the meme stock craze, I think it was 2021, like GameStop jumping up on no news. But it's very difficult to trade against it, especially in the US. The US doesn't allow single stock futures, doesn't allow contracts for differences. So the only thing is pretty much shorting the stock. But for shorting the stock, well, you cannot do that naked, so you need to borrow the share first. Sometimes there's no shares available to borrow. The fees might be extremely high. So I had cases where I saw that the fees was 100% of the whole stock price per year. Put options you can buy, but they are extremely expensive because of the very high volatility of these single stocks. So I think it's really difficult to trade against overpriced stocks. And overall, that's what you still see. I mean, even now, GameStop sometimes jumps up just on the news that the company might issue notes to buy Bitcoins. I think a few days ago, last week, it went up by 20%. And then on the next day, it dropped 15% or so. It's just so difficult to trade against overpriced stocks, while an overpriced stock is exactly as bad as an underpriced stock. It's just bad for the market if the prices don't reflect fundamentals.
Yes, and it is, as you say, it's very, very difficult to try and police that, particularly in the USA, where they do have some single stock futures, but they've been, broadly speaking, a failure due to actually high margins being imposed, which have made them entirely uncompetitive. Not quite as hideously uncompetitive as short selling stock, but in certain cases, but certainly not particularly effective. So there are elements that could be done to the market structure to manage to make things better, and clearly you're suggesting some additional or enhancement around the derivative sphere would give us some better opportunity to sort of price, particularly those middling or smaller stocks that get out of kilter. What about the role of the floor itself? I mean, you've mentioned a lot about how your research was comparing when the floor was open with after hours trading and so on. Is there something we can learn there? I mean, does the market quality degrade materially once the floor has closed?
So we did find that transaction costs got higher, I think a few basis points. So that might not sound but like much. I think we found like an impact of around 10 basis points. Doesn't sound much, but considering that the average stock has like a spread of, let me guess, 40 basis points, 50 basis points or so at the NYSE, so larger stocks, it's a pretty big impact. I mean, we also found that the price is less efficient. So overall, the impact seemed pretty large. I mean, with caveat, whenever you redo these kind of studies, the effect might shrink slightly. That's just how it works. But so, for example, we redid the study with more recent data, and we found a slightly decreased impact, but it was still like 5 or 6 basis points. So economically, it's a pretty large impact. I think there was a second part to your question, but somehow forgot that.
Oh, no, that's right. I was just curious. I mean, talking about the after hours market, and I think you've answered it very, very coherently. So you're saying there's several basis points of difference, which in the current pretty incredibly narrow spread market and overall cost base is significant altogether. And I'm just curious, therefore, is there a way that we need to have an expanded role for the floor out of hours? Because, of course, that could cause apoplexy, particularly as we look towards 24-hour trading, for example.
Well, I mean, I think in particular situations, it's just useful if humans can talk to each other. And I mean, doing that ad hoc probably doesn't really work because these ones are sudden. I mean, they can be planned. So, for example, during the opening times, unless, of course, there's 24 hours. But when the market opens, it's just more turmoil. I mean, there's more information that gets impounded into the price. So during these times, it's in particular useful to have some human interaction that allows to handle complex situation. Probably during the day when something suddenly happened, something unexpected, it probably also helps to decrease price pressure, to decrease overreaction, when traders can actually talk to the DMM and try to resolve like big orders that might not be informed, but that happen to be at the same time when like other changes happen. So overall, overall, I think it's useful if the opportunity exists to resolve like surprising situations.
That's very interesting. I'll give you a chance to get a sip of water there as well as you go along, because obviously that's quite a radical change in the 24-hour trading environment, because I don't think anybody's going to be sitting on the New York Stock Exchange floor at 2 or 3 o'clock in the morning when it's the middle of the Tokyo day. But then I suppose at the same time one could say the relative cost of dealing in an ADR or the relative cost of dealing in a stock overseas through a foreign DMM who's not got as liquid an amount of flow compared to what we're already seeing through the 24-hour US traded markets is going to give us quite a different picture. But it's certainly something that's very interesting to think about as we see US equity markets trading on a longer and longer basis. And I'm thinking particularly about those sort of magic, as they are at the moment, the blue ocean technologies hours between 8 p.m. New York time and say 4 a.m. the next morning, where you get a very, very big difference. And who knows? I mean, it's an interesting point to ponder what may be feasible to improve the overnight trading environment. Although I suppose at the moment, Asian investors are just thinking, gosh, it's so much easier not having to get up in the middle of the night to do my T+1 settlement and being able to actually trade right in front of me. Maybe those few extra basis points aren't such a problem after all.
Yeah, I think, I could imagine that flash crashes might be more dominant over the night. So there's some research on whether this machine algorithmic trading in general might make it more likely about flash crashes. I think the most famous was probably the SPY 2010, I think, where SPY dropped suddenly by 10% or so and then recovered within the next few minutes. So I guess if human trades with each other, it seems very unlikely that this would happen, while machines just react to prices as they are programmed to do, and therefore might trade against falling prices, selling with falling prices, as might have been the cause of this flash crash, blindly following their algorithm without thinking about the price pressure it causes.
And of course, there's two interesting points with that, and I quite agree. It's quite fascinating. Obviously, the first one is we have seen flash crashes specifically in Asia, such as Hanmag Securities in South Korea, where the algorithm blew up inside the box, and it took them 140 seconds to manage to turn the thing off, during which time I think it went from the prop trading company had positive $50 million to negative $50 million or thereabouts, and that's for 140 seconds. But it's also interesting because way back when, I can remember October the 19th, 1987, which a lot of people remember as being a particularly key date, not just because there'd been storms in the UK, which had wiped out the 6 of the 7 Oaks in Sevenoaks the previous Friday, but the stock market opened in Japan. Wall Street had a discombobulation late into the session. Everybody panicked. And actually, the Singapore International Mercantile Exchange, SIMEX, now part of SGX Group, their futures exchange, famously the Nikkei 225 stock futures opened with a huge imbalance of orders on the floor. And actually what happened was that a series of the local traders were essentially long of Nikkei, a lot of them, or certainly had been trading from the long side, because that was the mega Japanese bull market, which would go on for another 2.5 years at that stage. A lot of them just walked in and started buying this thing, and actually it was a kind of a human flash crash, because the price of that market opened ridiculous. I mean, tens of thousands of points. I think at that stage the Nikkei was about 30,000 or 36,000. They managed to open something like 10 or 15,000 below, if not actually at 10 or 15,000 points, and it resulted in the most incredible market imbalance. So sometimes humans can be irrational when they're panicking in the middle of the night as well. But I mean, I agree with you overall. I think that's the exception that proves the rule. So, okay, so tell us, I mean, you've mentioned the idea of regulation, smarter regulation, possibly a little hint of deregulation in the mix, better addition of, say, single stock futures in the USA, or alternatives, even contracts for difference or whatever, could be very, very useful. Is there anything else you observe about the benefit of floors helping markets that the NYSE floor brings to us right now that could be looked at by markets, not necessarily just in the USA, but around the world?
Well, I find it interesting, this idea of the parity trade. So there's always this concern that high-frequency traders might execute orders before the regular guy and therefore kind of rip them off. But then if you look at the NYSE, the parity trades kind of disencourages high-frequency trading, because even if you submit an order later, you still get a share. So there's all this talk about, or maybe not anymore that much, but like a few years ago, this idea that high-frequency trading is kind of a wasteful arms race. I mean, if that is the case, looking more at parity trades might be an interesting aspect, because I didn't see much talk about it, while I find it an interesting feature.
We could have this argument for some more intelligent order types. There's a debate that, well, good grief, has been running amok for many, many years in the stock markets of the world. Quite interesting altogether. Dominik Roesch, we've reached that point in the program. We've been talking about how floors help markets thanks to your fascinating academic research. You've given us some illustrious examples thereof. But do tell me, on the macro, Dominik Roesch, where does the capital market revolution go next?
Well, so I think it's always important to realize that a lot of the future will also be similar to the past. So every time there's a new technology, everybody thinks everything will be completely different. So this time is different. Most of the time, in a big sense, it's very similar. So firms will still raise capital using equity, using debt. This equity will trade one way or another. These are the big things that were just similar. On the other side, I think this idea of AI, this idea of machine learning, I think it might make market actually less efficient over the next years, partly because these algorithms, these machine learning techniques, they are based on picking up correlations that existed in the past and therefore extrapolate this idea to the future. If traders now believe their ChatGPT suggestions, it will become a self-fulfilling prophecy. Markets will do indeed exactly what they did in the past. Markets will get less efficient because they don't incorporate the latest information anymore. Trading against that is extremely risky because it's very difficult to trade against overpriced securities till, well, I guess at some point, market will be so far away from the fundamentals that people will realize, and then it will crash. So I think overall, these new technologies need to be used carefully, and they don't replace the idea of like traders that actually analyze the fundamentals of companies.
Wow, I have to say, I think that's one of the most comprehensive answers to the revolution question we've had in a long time. A lot to unpack there, but plus ça change, plus ça le même chose. In one sense, humans still matter very much in another, but at the same time, be careful what you wish for in terms of new technology, says Dominik Roesch, because there are all manner of pitfalls to come from these newfangled wonderful things, including machine learning, AI, etc., etc. Dominik Roesch, it's been an absolute pleasure to have you on IPO-VID discussing how floors help markets. We're going to be back next week, ladies and gentlemen, with another show. I want to thank our fabulous production team today. Thank you very much, Jamila, Aracy, and Natalie. Final word of thanks to Dominik Roesch. I'm fascinated to read more of your academic papers along the way. We wish you all, well, a very, very pleasant extension of spring from Buffalo in New York. And my name is Patrick L. Young. I just want to say, if you're looking for a market built, don't forget, get in touch. And of course, you can contact us or catch up with the water cooler of the Bourse business in Exchange Invest at exchangeinvest.com Monday through Friday. We'll be back next Tuesday. My name is Patrick L. Young. Thanks for joining us today. Thanks for joining this IPO-VID discussing how floors help markets. We'll be back, same place, same time next week. Have a great week in life and markets.